one thing that's popped up in the last couple of weeks that has surprised me is 25% down instead of 20% down has yielded, usually it yields a lower interest rate. Like that's not new. However, it's made more sense, just math, to do 25% down. And there are very few times that ever makes sense. In other words, that the ROI is higher with 25% down versus 20. So
yeah, in other words, the rate is that much better.
Yes.
People. In addition, when you're talking about all these levers, you know, all these levers shouldn't be pulled or moved independent of each other. Sometimes they have to be moved together. Mm-hmm. So for instance, sometimes if the 25% down rate is better, sometimes the buy down is also better on the 25%.
Good point.
Right? So sometimes, you know, just asking the right questions of the bank is really, really important, you know, because it can make a huge difference. If you're talking about a 1/4 point difference on rate on a 25% down, and then you can also get further down with a rate buy down than you can on the 20%. It just means the bank wants you to, they want to loan 25% down paper. And because of that, they're making it more attractive, right? And so if you only ask the one question, you're only going to get one. But if you ask both, it may be a twofer. You might actually get a better spread on the rate buy down and start at a better interest rate to begin with. So,
yeah, good. That was good. I would say another point that I met a client live yesterday, which was super weird for me. I don't do that very often. I'm often on Zoom or on the phone. Somebody came to see you? I know, it was weird.
That is. Wow.
So I was talking to them about cost segregation and explaining, you know, the 100% bonus depreciation that you can write off is going to decrease after this year to 75% instead of the full bonus depreciation. And their eyes were like, wait, what? And I said, yeah, it's significant. And if you can, and they can qualify as a passive real estate professional. And I said, you might want to and at that point they were like, who even cares about like everything else? I'm going to buy just to get that final year of solid depreciation, you know? So that was kind of something.
Take everything into consideration, right? I mean, I think that there are people out there who would tell you that, you know, you could buy a negative cash flowing property because, you know, you get the tax write-offs and it offsets. True. Well, I think that's a really bad idea. Yeah. Where you can buy a solidly cash flowing property that may not be as good as it was 4 years ago, but get 100%, you can get this 100% bonus depreciation. That actually is a no-brainer. Yeah. And then imagine if you can do all of that and pull a couple of other levers. Mm-hmm. Like all of a sudden, this 1% increase that we've had, which is not earth-shattering to begin with, it's just not that big of a deal. Yeah. Right. And all of this is going to become more and more important as we start to head north towards 6%, because the prices aren't going to adjust immediately. I think that's another fallacy out there that people think that everything's just going to collapse and prices are going to adjust. I literally don't think that's going to happen. It's not going to happen. It's going to take some time. It's also not going to happen, I don't think, in the commercial world. There's going to be a lag where there's this cap rate compression that happens, and you know, people are still going to be paying ridiculous prices for properties even though interest rates are going up. And they don't necessarily track equally, I guess is what I'm trying to say, always. Eventually I do think it'll catch up, but nobody knows how long that's going to take. And so in the interim, it's really important to understand one of the big drivers of cash flow is your financing. And you need to understand how to use all of the benefits, I guess, that are available to you to make a good deal a better deal.
Yeah.
So,
yeah, that's a good point.